It's been a rough couple of days when you look at the markets, stocks, bonds, these extreme sell-offs, a lot of these flows going into the dollar. I'm curious where the labor question really falls into it. What are investors reacting to here? Is it the 75 basis points? Is it the payrolls number? Is it the labor participation rate? Your take.
Creedy, thanks for having me on, and happy Mother's Day to all of the mothers out there, including mine and my wife's. I think in terms of what the market is reacting to really is the future, and what's coming up next week is probably more important than the labor market report. That's the CPI inflation report. We've had a couple of, inflation reports here. I'm thinking about the PCE numbers that we've gotten over the past 2 months, and they have been more reasonable reports than what we had over the 4 months prior to that. Chair Powell did reference that. So I think ultimately it comes down to inflation, Creedy, and next week's report is going to be very key to markets going forward.
What do you think that number's going to look like, Matt?
Well, Guy, we think it's going to be a good number. I mean, ultimately, the trends in underlying inflation in the U.S. are strong, particularly with the housing market. In the last segment, I saw you talk about home builders. That component of inflation we expect to continue to be quite strong. So underlying inflation should hold up, Guy, but it's really about all of the other factors that had been boosting inflation towards the end of last year, early this year. That's really where the rubber is going to meet the road.
Matt, I'm curious about the currency picture here. If you are starting to see a lot of these investors hop out of stocks, hop out of bonds, and go to cash, is the dollar here a no-brainer trade?
Well, I mean, ultimately, the dollar is rallying on a combination of factors, as it usually will move to. One, of course, is the policy divergence that we see being put into place by the Fed against the Bank of Japan, against the ECB, against the PBOC in China. You also have growth elements that favor the dollar currently. Those include certainly strong growth in the U.S. economy, the labor market report this morning, a hat tip to that idea. But then when you move overseas, you do see weakness in China. There's concerns about the zero COVID policy approach in the marketplace. And then, of course, there are concerns about what's happening in Europe. So the growth expectation channel also has been favoring the dollar of late.
Matt, do you think we're still underpricing the Fed? How far does the Fed need to go here? You've got Kashkari on the tape now talking about the fact that we basically need to deliver on the forward guidance that has been laid out by Chair Powell. Where do you think ultimately this takes us? How high do rates in the United States need to get in order to deliver the demand destruction that the Fed needs to see?
Well, Guy, I mean, that's a problem that's multivariate. If I just look at the U.S. economy, I think the Fed could very easily get back to where it was in 2018 without really causing much demand destruction. Morgan Stanley economists led by Ellen Zentner are looking for the Fed to go higher than that. And I think that seems completely appropriate at this stage in the game. But when you broaden the lens and you look outside of the United States, that's where the waters get more muddy. And I think ultimately the U.S. economy does operate more on an island than other parts of the world. But, as we make our way deeper into this year and we get to see what exactly transpires with China, what's happening in Europe, then I think we'll be in a much better place to know, does the Fed have to go into restrictive policy territory or not? And I think the same holds for the Fed.
Matt, I feel like you hit on this really key point that the U.S. does kind of operate on this island. It's interesting that you talk about the recession chances because it almost feels like the consensus here is that recession isn't in the cards for the United States unless the Fed does something out of the ordinary. But Europe, China even, the export picture that comes out of there, the inflationary picture, particularly out of Europe, is concerning. Recession is on the table for those two economies. And I'm curious how much of that can actually drag the United States down as opposed to the other way around.
Well, Creedy, that's exactly why we have to pay very close attention to financial markets, because the transmission channel typically from outside the U.S. into the U.S. You're right. I mean, exports and global trade, that's a key component of the transmission mechanism. But financial markets are also a key contributor to that transmission into the U.S. economy. So if the equity market continues to trade on the weak side, which is what our chief U.S. equity strategist, Mike Wilson, is looking for, then that could have an impact on the U.S. economy much earlier than any traditional economic analysis would suggest.
Matt, let's just talk about some other central banks. Critty brings up what's happening here in Europe. Bank of England yesterday. The Bank of England signaled a recession and hike rates. How many more rate hikes do you think the Bank of England is going to have to deliver? We've got inflation heading for double digits. That's emerging market territory. The bank then expects that inflation picture to absolutely collapse as demand gets crushed. In order for the bank to deliver on its mandates, in order for it to do the right thing for the UK economy, what are you guys now thinking? What do you expect to happen, and how should one position around that story?
Well, Guy, if the message from the Bank of England sounded confused, I think it just reflects what most investors are thinking these days. People are very confused. Now, in terms of what we're expecting, we do see another hike, but after that, we don't really see much from the Bank of England because we do have growth coming down quite substantially. So when you look at Morgan Stanley Economics and their forecasts for the Bank of England policy, a bank rate in this case, we're way below where the market is currently priced. So one of the key recommendations that we are out with after the Bank of England meeting is for investors to be in yield curve steepening exposure. So to be long 2-year gilts versus short 10-year gilts, looking for that particular part of the curve to steepen up. That's a key message from us in the wake of that meeting, Guy.